So we'll just move on to part B in this video. So here they are expecting you to make the account of Alexander in the ledger of Umar. So if you think from Umar's perspective, Umar is basically purchasing goods from Alexander. So Alexander is the trade payable here. Students need to know what perspective they are thinking from. So let's say it's Umar's business here and you need to think as Umar. So Umar is purchasing goods from Alexander. So Alexander in this case is credit supplier for Umar, and a credit supplier is a liability. Liabilities have a balance brought down on the credit side, and whenever you record the transactions in the liability account, so whenever you are purchasing goods, you record that on the credit side, your liability towards the supplier increases, and whenever you are paying them or returning them goods, your liability towards your supplier decreases. So what you have to record here is, firstly, you need to mark all the transactions that you need to record here. So this transaction, that is the second transaction. Then we have another transaction with Alexander, that is the transaction on April 12th. Then we have another transaction with Alexander, that is transaction on April 27th. Then we have another transaction with Alexander, that is transaction on April 28th. So what we'll do here, first we'll just go one by one. April 7 will be recorded on it was recorded on the credit side in the cash book, so it will be recorded on the debit side of Alexander's account. I'll write here bank and I'll write here 360, and this will be April 7. Then I'm purchasing goods from Alexander on credit, so I'll write here April 12 on the credit side. So if you think of the double entry in this case, purchases is being debited, Alexander's account is being credited, so our liability towards Alexander is increasing. I'll write here purchases, and I will write here in the amount, I'll write 340. In the next transaction, that is on April 27, we are paying $323 by check to Alexander. So bank is being credited. So that is recorded on the credit side of the bank account, that is in the cash book. You write here, again you write here bank and you write here 323. So you were supposed to pay 340, but you are paying 323, which means Alexander is also giving us a discount. So I write here discount received. So discount received, and I write here $17. So this is April 27. I'll write here April 27. And in the next transaction, that is April 28, purchase goods 235 on credit from Alexander. So if you're buying goods on credit from Alexander, you write here April 28. You again write here purchases, and you write here 235. So notice here that basically you had a balance, so there was a liability in the start of the month, then you paid off that liability by paying a check to Alexander. Then again you purchased goods on credit from Alexander and paid off that liability by giving a check of $323 and receiving a discount of $17. Now again you have purchased goods of $235, which means my liability in the end, if I do total of heavy side, that is the credit side is the heavy side, and I subtract the total of light side from the total of heavy side, I'll be left with 235. That is my balance carried down April 30. And then now I just write the totals of this account. So basically the total of this account will be 935. And this balance carried down will become your balance brought down on 1st May 2023. You'll write here balance brought down, and you'll write here 235. So this is for 4 marks, but it's very simple, so you have no reason to do it wrong. It's very simple. You just need to record the transactions, like whenever you're purchasing goods, your liability towards the supplier increases, you record that on the credit side. Whenever you're paying them or returning them goods, your liability towards your supplier decreases, so you need to record that on the debit side. So this account basically increases on the credit side, decreases on the debit side. That's it. And for part C, so in the next video of mine, I'll be solving part C. Thank you guys.